Welcome to NASDAQ Trade Talks. I'm Jill Malandrino, Global Markets Reporter at NASDAQ. Clayton, Dubilier Rice, KKR, and Epicor Software announced a definitive agreement where CD&R funds will acquire Epicor from KKR. Joining me to discuss the transaction is Steve Murphy, CEO of Epicor. Steve, congratulations on the deal and welcome to Trade Talks.
Hey, thanks, Jill. It's great to be here.
Tell us about Epicor and more details around the acquisition.
Yeah, you bet. So Epicor is a software company. In a nutshell, we make and sell business software to manufacturers, distributors, and retailers. And Clayton, Dubilier Rice, in this case, very similar thesis and portfolio companies. So in many cases, our customers would tend to be a company they may have invested in. So there's a lot of nice commonality there.
Steve, let's talk about the pros and cons of acquisitions in the middle of a pandemic. Certainly the way companies are accessing the capital markets or doing deals is definitely different in the COVID-19 era.
Yeah, you're right. It's been fascinating. So in this case, it's from a numbers standpoint, it's a big deal. And in the case of the teams, we did almost everything remotely. So whether it was Microsoft, Zoom, or Teams, we were able to get to know each other remotely. Now, in one case, there were two of us that traveled quite a bit and got to know each other, myself and Jeff, who's going to be the chairman of the board. So it wasn't done completely without some human interaction. But in this case, almost entirely done over Teams, which I would have guessed a year or two ago couldn't be done. So it's amazing to me that the relationships are able to build, people get to know each other, it still works. But there is, I would say at this point, it's not totally AI. There is some human interaction still involved.
Why did the team feel the acquisition was the right choice at this moment in time?
Yeah, so I think in this case, you could look at it from our perspective and their perspective. I'd say from CD&R's perspective, they really like the fact that we have a lot in common around know-how. So for instance, whether it's industrial manufacturing, industrial equipment, building materials, hardware stores, they already had a ready-made understanding of our business. And in many cases, like I said, they've got companies in the portfolio that run on our software. So when we met each other, 3 or 4 months ago, they knew quite a bit about us. And I think they felt like independent of the quality of the asset, the return they could get on the investment, it was also a really good fit as far as a software company that could be a part of their family and modernize all of the companies, the industrial companies they already own. So they were a logical buyer. From our perspective, they've got a great reputation. They like to invest in innovation and growth. And we're well into our journey as far as the cloud goes, seeing really nice growth there. And that's as big a part of their thesis as ours, which is invest in those cloud software products and continue to grow that business. By the way, that business has grown 60% year over year or better for the last 3 or 4 years. So it's really becoming a really large part of our business.
Well, it's certainly a great time to be in it as all kinds of industries are moving towards digitization, and certainly the industrials have a lot of catch up to do there. So let's dive deeper into the strategy. What led to the valuation that you were able to achieve?
Yeah, I think that if you think about the valuation, you'd come back to largely two things. One would be the size of the cloud business. 3 or 4 years ago, Jill, it was a small part of our business, maybe 3 to 5%. At this point, the actual subscriptions are about 200 million out of 900. So you could say 2/9 or more than 20%. It's become a very substantial part of our business. And it continues to grow at the rate it's grown at, which is that number gets bigger is pretty impressive. I think the other thing is if you take a look at the products themselves, they tend to be very sticky. So our customers stick with us for a long time. They tend to reinvest. They tend to buy more users. So we have retention rates, net retention rates in the 108%. And just so you don't scratch your head when you hear that number, it means every year customers not only renew what they had, but they spend about 8% more. So when they took a look at the recurring revenue and the quality of the revenue, they could justify that kind of a price because they knew what they were getting. You could think about it like a bond with a call option, where the bond is this recurring revenue stream and the call option is this great suite of SaaS products. I think that was the biggest lever that drove the valuation.
So, Steve, what should companies be considering when presented with an acquisition offer during this time?
Well, I think fit's big. I think that for us, being able to look our customers in the eye and say, hey, this is really good for us. This company has a great reputation, CD&R. They've been around for a long time and they invest in growth. So if that's what your customers expect to hear, it's got to be true for starters. But I think thinking long term about if you're going to stick to the plan, you've got to, if you're going to get married to somebody, make sure somebody that's got the same values and principles as you do. And if you do that, it's likely to work. And this was a very healthy process. We had options. We had multiple bids, and there were some really qualified buyers here. But the thing that, for me, really tipped the scales in the favor of CDR was their willingness to invest. And they were very serious about that. And their knowledge of our products. When they talked about investing, they knew specifically where they wanted to invest and why. And it aligned very tightly with where I want to invest and why. So I felt good about it. That made a difference.
Yeah, that certainly does make a difference because, of course, when you're investing and putting money into R&D, that's what sets you up for future growth. So it is encouraging to hear that in this kind of environment, that they're willing to make those kinds of investments for sure.
Yeah, definitely. And at times like this, it does seem like big tech, and we're not, we're $1 billion. We're not huge, but we're on the edge of big tech. And for whatever reason, we seem to be seeing a very healthy second half of the year. Business is good. And I think there's a lot of pent up demand coming our way from the bit of the slowdown around March, April. That doesn't hurt either. And to your point, you get some really good proof points around where do the investments make more sense? What are people buying right now? And what would they tend to buy in the future?
All right, Steve, thanks for joining us on Trade Talks, and congratulations again on the deal.
Thanks, Jill. Bye.
And thanks, you're welcome. Thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at NASDAQ.